Thank you. There's Paul's information. Okay. Last but not least is Sam K, because I won't try to pronounce it because it will be incorrect. Sam is a fintech entrepreneur with an extensive background in the marketplace lending industry. Before Corl, Sam spent the past 6 years leading the definition and go-to market strategy of innovative fintech products and solutions in the payments and lending industry. Most recently as the head of product at IOU Financial, where he was one of the leading figures in taking the company from a small private marketplace lender to IPO in 2011. Currently, for the past year, Sam has been the co-founder and CEO of Corl, currently launching the Corl token, which is aiming to become the world's first revenue sharing token designed to support and participate in the growth of emerging technology companies built on top of the Polymath platform. Sam is an early crypto hodler, not holder, and an advisor at Lendmart and Fundica, and holds a Master's of Engineering degree from Concordia University. Sam, come on up.
Hey everyone. So as Jared said, I'm Sam. I'm from Montreal. Go Habs. No love. All right. All right. I'm here today not just to talk about Corl and what we do. It's more about our vision and why we started Corl in the first place. It's based on a philosophy that we believed in and how we moved forward with things. So we're talking today about a very topic or like a subject that you've been hearing about all the time, tokens or ICOs or ITOs as I like to call it. Derek always reminds me it's called tokens, not coins, so we always have that argument. And we're gonna see why we call it tokens, not coins. Just by raise of hands, any of you guys own any of these coins, tokens, whatever you wanna call them? All right. It's insane because I relate to Leia because for some reason since I started working or having an entrepreneurship journey in the blockchain space, all my friends want to talk about that, right? Some people meet me and put me on their phone book as Sam Crypto or Sam Bitcoin, which is a bit annoying when people start calling you that. So blockchain in general has unleashed a global financial disruption, right? We've seen the sharing economy disrupt the middleman, and we're seeing blockchain do the same thing in the financial world. A chart that we've seen a while ago, total market cap and crypto in general. I've presented the same slide I think 2 months ago, and it was probably the numbers were half, and it's insane how the numbers have jumped up. So what are initial coin offerings or initial token offerings, right? Are they actually the dawn of crypto finance, or is that the transition of how the world is going to move in the financial world? I like to start my presentations with asking a bunch of questions about what people think this number means. So what do you think you can do in 30 seconds? Any ideas? You can change your relationship status on Facebook. Or you can raise $35 million like Brave did in 30 seconds. Another question for you. What about 3 hours? All right? You can roast a turkey. Or you can actually raise $150 million like Bancor did. These are insane numbers. When you're talking like raising 35 and 150 million in such a short amount of time, it's like you're talking, it's like, where the hell is this coming from? Like this market cap at this point, we've raised over $4 billion to date just through ICOs and ITOs. So why is this happening, right? Is it just because people have this crave for money and this is the next big thing and we have FOMO? Maybe, you never know. Some people actually do it. And that's one of my best pictures from the McGregor versus Mayweather fight. I thought it's relevant. But there's more than that, right? It's beyond just having money and getting rich. There's people believe in a philosophy, people believe in a vision for the market. But let's take a step back. The evolving state of ICOs and investments in general, and what triggered that growth. 2009, we've seen the rise of blockchain assets, but it's pretty much limited to buying and selling Bitcoin and cryptocurrencies in general. We've seen it evolve in 2013 with more models for adoption, like crowdfunding or crowd investing, so using that network for that, right? So that was, I believe, the first ICO or initial token offering was done around that time. With 2017, we've seen it evolve to more, where it started getting adopted by other startups and the community, where it became a means of kind of disrupting the venture capital or funding space. We've seen some good stories, we've seen some bad stories, and we believe that the market is getting stable and it's going to get wiser, and we're going to see better stories over time. Despite all of this craziness that's happening in the market and these huge numbers, all these initial coin offerings or token offerings have been utility tokens. What I mean by utility tokens means they're not backed by an asset, so like they're not backed by real estate or an equity or a loan, right? So they have no future value. And come to think about it, out of that 4 billion I just mentioned, 0.25% is actually a security, which means they have a value, they're backed by an asset. So what are we talking about here? Traditional assets and tokenizations. Like a lot of people are talking about that space, so what does it actually mean? So if you look about the traditional asset industry that we talk about in finance, right, whether it's real estate or equity or debt, commodities, even artwork, right, hedge funds, individuals, retail investors, there's a lot of buzzwords that we hear about, and that industry in itself is over 217 trillion, right? Now, if you take that traditional sense of the financial world and you put it on the blockchain, what we call tokens, and that's why we call it tokens, not a coin. And there's an idea that I like to talk about here. So right now, you need a bank to get a loan. RBC is sponsoring this event, so I'm not going to talk a lot about banks and how you can disrupt that. But imagine one day you need a mortgage. We'll reach a world, maybe in 10 years, 5 years, if not even sooner, where if you want a loan, you create a token for your own house, for your own property, and you offer it on the market, and you finance your house like that. So now you have tokens for your mortgage. Right now, if you want to buy a stock, you have to open a broker account or a stock purchasing account through your bank, direct investing, or whatever. You have to pay your fees, buy a Google stock or Airbnb stock, whatever you want to buy down the road. You have to pay that $9, $10 fee, whatever the cost. But what if you can simply just go buy a Google token out there, right? Or an Uber token if they go public or whatever. Any asset you can dream of, you can simply just purchase a token and that represents it. You want to participate in a loan that was done to a business, you just go buy a token, and now you're getting a percentage of that interest. When we talk about traditional asset tokenization, and that's the vision we believe in, we see that the financial world is going to go towards that approach and having a token for every simple asset in the financial space. One case study that we like to talk about, specifically that we're in that space, is startup funding. If you look at startup funding in general, it's been friends and family round, angel investments, venture capital, crowdfunding, equity crowdfunding recently, peer-to-peer lending. Now, what if you combine the concept of sharing economy, crowdfunding, and blockchain? How can we, there's been a lot of innovation in that space, and how can we take it to the next level? And that's what and that's where Corl started their journey. We started our journey with what we call revenue sharing over the blockchain. So what we did, basically, we created a token, and that token represents ownership in our company. And as a product, we inject capital in companies, but instead of taking equity or board seats or even a traditional loan with an interest rate, we take a percentage of their revenue until they pay us back. As a result, token holders will receive a portion of our dividends on a quarterly basis based on our profit as a company. So we just merged different worlds through the blockchain, through our platform, and now we're pushing forward with our financial innovation. And we see 2018 as just the beginning. Polymath, our partners, are creating the best platform to actually tokenize those assets. And we're going to see a lot of improvements in that market, whether it's capital market, exchanges might have their own coins. There's different protocols. So like Bitcoin is a protocol. There's Polymath launching their protocol. And there's different platforms that are going to start using their own coin. And you're going to see every asset down the road become a token on its own, where you can simply just buy it on the in the crypto space or the blockchain market. Right? Any questions?
Questions?
Go on there.
Who is your target customer, and do you have any signed up?
So we're a two-sided market, right? So on one side, we have the businesses for the revenue sharing agreements. We target businesses that are more in the early stage, so like tech companies, like SaaS companies with a recurring revenue model, companies that have established revenue, they have a product market fit. That's one side, right? Our token is basically, will be will be the first regulated security token, so obviously be purchased by retail, accredited investors worldwide, with the exception of countries where it's banned, like China. We don't want to deal with the SEC at this point, South Korea. This is what we're not targeting in the token sale. We have over 250 early access requests with zero marketing spent at this point. This has been completely organic, and we recently partnered with MLG Blockchain to lead our community engagement and to grow the network to the next 50,000 communities. So.
Hi, Natalie. Thanks for the presentation. I just wondering, in terms of the tokenization assets, what are the chances of, sorry, these companies going bankrupt because they are not actually being backed by traditional assets? And my second part of question being, since traditional banks are not really in for a lot of innovation like blockchain, what are the chances of them buying out these particular companies and just completely shut down the disruption?
It's actually a good question, and that's why we make the difference between utility tokens and security tokens, right? So when we talk tokenization of assets, we mean security assets. And what you hear in the space now, a lot of ICOs or initial coin offerings, most of those are utility tokens, right? These are companies, some of them have good ideas, some of them have very bad ideas, and they're just a scammy approach of raising money, and we've heard about a lot of bad stories in the news. We've heard about legal actions taken against them. So when it is a utility token, at this point, you're investing in buying the token because you believe in a project. Whether that project is going to fail or succeed is going to influence the coin at one point. But when it's backed by a security, when your token represents an equity in the company. So in Corl's case, the token represents an equity. So anyone who holds a token owns a share, earns dividends, have liquidation preferences. If we sell the company, if we go bankrupt down the road, that's not going to happen. We're a stable company, you know what you're doing. Or the token can also be a lending company, right? So there's a lot of lending companies that say your token represents a loan. So because that token represents a value, a financial asset, the only way that token will go bust is if that company shuts down. But because that token is backed by an asset, let's say you can have a token to buy a real estate project. So you're getting the returns from that real estate project, and that's what influences the token. And that's what we call stable coins in a way, because they're not pegged directly, but they're relatively dependent on that asset itself.
Hi, here. Do you think pre-leaving a share of the revenue of a startup company can have an impact on its development?
It depends which companies you're targeting, right? Obviously, if you're taking a very early stage company with zero margins, definitely it's going to impact. So what we do at Corl, we look at companies in the range of 35 to 50 monthly recurring revenue a month, 30% gross margin. We take up to 10% of the monthly recurring revenue, the top line, so that even with that 10%, you have 20% remaining, which studies have shown it's enough for you to grow slowly. Obviously, we try to target better gross margins. Anything less than that can impact financially the company. But if you think about it from the other side, taking a loan as a company where you have to pay $7,000 a month with economic uncertainties, you're not sure what your revenue is this month, can even impact you more. And it's a good balance between giving up equity in your company from day one, or going through a traditional financing approach, which most startups would not qualify for through a bank or traditional loan, right?
Last question.
Right. Given the relatively anonymous nature of crypto in general, like how does that impact the creditor relationship that like your tokens would have, and also too, is that something you guys consider about like giving people attaching more information to these tokens?
Exactly. So what I didn't mention, like, because I was trying to highlight more the industry itself, but it's a good question. Corl itself is the world's first or planning to be the world's first regulatory compliant securities token. What I mean by that is our token requires KYC. So we've built KYC, or know your customer, capabilities into the smart contract. So for you to buy the token, you'll have to come to our platform, sign up, do a pre-screening like anti-money laundering checks, sanctions, upload your government ID. We do some checks, and that is cryptographically signed and assigned to your Ethereum address. So now we know that this Ethereum address belongs to this individual, they're whitelisted. So if you try to send your token to someone else that haven't been KYC'd or whitelisted, the smart contract will block the transaction. We even took it to the next level, and that's what the regulators love to hear. In the investment world, there's different accreditation status, right? Retail, eligible, accredited, and everyone has a different limit of how much they can invest. And through our platform, we can tag what type of investor you are and embed that in the smart contract. So if you're trying to hold more than your limit or try to sell more than your limit, the smart contract will block that functionality. We see that the regulation space is coming to the blockchain. There's no way to avoid that, especially when it starts to move into tokenization of assets. It's a must. You can't have that anonymity anymore. Some people will argue like, well, but that's the whole point of blockchain. It's supposed to be anonymous. But if you want to see it applied in different financial sectors, see banks adopt it, governments adopt it, it has to be done. And 2018, I think, is the year where we're going to start to see regulatory approaches for blockchain and tokens in general. And we're happy to be leaders in that space.
One last quick question.
Hi, Sam. Thank you for presenting us
Where?
with Corl. Oh, sorry. Hi. Hi. My question is as it relates to how Corl is fundamentally different from a traditional royalties-based company that may be considering a traditional IPO to raise funds, then invest in either startups or existing companies collecting a royalty and giving that back to investors. How are you fundamentally different?
So if you look at the royalty space, the concept of royalty is not completely new, right? It's been applied in music industry, in oil mining and gas, pharmaceutical. So the concept of royalty or revenue sharing as we know it is not entirely new. What we did new is the operational and management aspect of it, right? Our platform taps into businesses' accounting systems, payment gateways, bank systems, just to kind of gauge what the revenue is. Managing a royalty agreement is a nightmare. You have to know what the revenue is on a monthly basis. You need to be accurate about your data. You need to know how much you're remitting as revenue, how much you're paying people. So that operational aspect of it is part of our platform. How is it different from an IPO? Obviously, Corl could have taken the decision to go public on day one. It is not easy for a fresh company to go public. Your valuation is going to be way lower. And it's also part of a philosophy why we're different, right? We believe that the whole tokenization of assets is coming, and we wanted to be leaders in that space. We didn't just want to do a token because it's a buzzword or it's cool. We believe that's where the space is heading. And we positioned a hard-to-manage asset. You can't have access to a lot of royalty investments out there unless you find a company that's public. And there's probably few in the world that are doing specifically in investments in startups. And most of them are very later stage companies. And what we've done is we created a token that gives access to an easy royalty investment approach with better efficiency for us to manage those startups and that portfolio while giving everyone the dividends and the returns they expect from that industry.
Awesome. Thank you, Sam.